Hey guys, welcome back to another video. In this video, I'm going to be talking about Google. And as we can see over the last few months here, year to date, Google is up 12%, while the rest of the market is only up about 5 to 6%. So it is outperforming the market over the 1-year chart. And Google has basically been returning a lot of value back to shareholders recently. Obviously, there are some other tech companies like Nvidia that have been doing a lot better. But if you have been invested in Google, then you have been obviously experiencing a very large return very recently. So in this video, I'm going to talk about their Q4 and full year earnings and revenue results for 2023, which were actually very impressive and very optimistic for the future. And then I'm also going to look into their financial statements, talk about their business model, and finally figure out the intrinsic value per share for Google so we can know if this is a good time to buy into the stock from a value investing perspective. So first things first, Google's business model is pretty straightforward, but also there are some future catalysts that could actually end up propelling Alphabet's revenue even more than it currently is. The largest portion of Google's current business comes from advertising. Advertisers spend money bidding against one another to get their ads shown on Google's search engine, YouTube videos, and other platforms owned by Google. But the fastest growing segment of Google's business is the Google Cloud, which encompasses different cloud computing products and data analytics platforms provided to customers by Google. Google Cloud posted a large increase in operating profits in 2023 compared to 2022, when they actually had a net loss in the operating segment. And so if this segment of Google's business continues to grow in the future, it could add a substantial increase in revenues and profits to Google's business, which could end up increasing their share price in the stock market. Google's recent investments in artificial intelligence have played a large part in the recent increase in their stock price. AI is fundamental to improving Google's search engine and increasing customer satisfaction by providing more tailor-made ads to customers, thereby driving more advertising revenue to Google's business. Google also has been using AI to invest in new business areas such as autonomous driving through Waymo, which is a subsidiary of Alphabet, and also through their investments in quantum computing. Lastly, AI can be used to enhance the content recommendations on YouTube, improving user engagement and satisfaction while managing the platform's vast content scale. Better recommendations increasing viewer times would obviously be beneficial to Google's business, thereby driving more ad impressions and revenue to Google's revenue. Overall, artificial intelligence acts as a catalyst that could propel Google's business forward by capturing new markets and creating additional revenue sources. So now that we're done talking about Google's business model, I wanted to talk about this article I found titled "Google Stock Hits All-Time High with $2 Trillion Valuation in Sight." As I stated at the start of the video, Google has been returning a lot of value to shareholders, which is especially impressive considering how big Google already is. The fact that they're continuing to grow and just now showing segments of their business that are turning a profit, which could increase in profits in the future, show a lot of good signs for Google's growth in the future. Right here, they point out that Google parent Alphabet registered its highest share price ever on Tuesday as the search engine titan rides the artificial intelligence wave to a historic valuation. Their total market value was around $1.95 trillion, putting it within 3% of registering a $2 trillion market cap, a milestone that was achieved by Google for a few minutes in late 2021, but otherwise has really only been reached by Apple, Microsoft, and Nvidia in America. Alphabet's most recent flirtation with a $2 trillion valuation comes from a 13% run-up in its share price year to date, which is now 11%. Obviously, it's fallen a little bit, but mainly because the overall market has fallen a little bit. And then also as a result of a 77% jump dating back to the end of 2022, which was a stock market rally spurred mainly by record profits due to resilient advertising spending and also on the back end of investor optimism, partially inspired by their investments in artificial intelligence. And as Alphabet's price to future earnings ratio sits right now at one of its highest levels in 2 years, it's an indication that the market is betting on future unrealized profit potential for Google, which is obviously a really good sign. Wall Street largely expects Google to pass the $2 trillion mark, and the average analyst price target for Google is $166, which is obviously up quite a bit from their current $156 share price. Also, there are some bulls for Alphabet that are betting that Alphabet might increase to $185, which would be a substantial leap from where they are currently at $155. And they are very bullish on Google because of the optimism from Google's investments in artificial intelligence and how that could apply to their search engine and to their YouTube business. 19% is the annualized rate of return on investment for Google shares over the last decade, which easily beats the S&P 500's 13%, but falls short of the more than 20% annual returns achieved by some of their American peers like Amazon, Apple, Microsoft, Meta, and Nvidia. But that being said, it's still pretty impressive. And also, after its share price fell nearly 40% in 2022, their business recovered nicely as advertising spending proved stable, while the US seemingly avoided a full-blown recession, which has long been feared. Might still be coming up, but so far it hasn't happened. And then obviously they point out at the end here that advertisement revenue accounts for more than 3/4 of Google's total revenue. But as I stated at the start of the video, as the cloud computing segment of their business becomes more profitable and continues to grow, it could end up adding more profit and more revenue to their business outside of just their advertising revenue. They end off the article by pointing out that Alphabet is expected to report their first quarter earnings later on, actually probably going to be pretty soon here. And the average analyst forecasts predict that the company will report a record Q1 profit of nearly $19 billion. So a lot of good news for Google. Obviously, investors and analysts are expecting that Google is going to continue to grow a lot in the future, which is very impressive for a company that's already as large as Google. Now we can look at their income statement here for Q4 and for the full year of 2023. They reported some really nice increases in revenue and earnings for both Q4 and the full year. For Q4, it increased 13% from $76 billion to $86 billion for their top line revenue. And for bottom line net income, that increased 54% from $13 billion to $20 billion. Very impressive earnings growth in the fourth quarter for Google. For the full year, their revenue increased by 9% from $282 to $307, and their net income increased by 23% from $60 billion to $74 billion. So in both cases, for Q4 and the full year, their earnings actually increased even faster than their revenue, which shows that their revenue is increasing at a larger amount than their cost of revenue, which is again more good news for Google. Lastly, we can see right here on page 7, they show their cash flow statement, and they show that for the fourth quarter and for the full year, how much they repurchased in common stock. They repurchased $16 billion in the fourth quarter and $61 billion in the full year of 2023. And obviously, as they continue to repurchase shares of common stock, that'll continue to boost the share price for Alphabet. So that's obviously some more good news here for Google. Now we have this discounted cash flow model to try to figure out the intrinsic value per share for the company. I'm using a growth rate of 17%, which I got from this historic growth rate calculator right here. I basically took the free cash flow from 2019, which was about $30 billion, and then compared that to the free cash flow in 2023, which was about $70 billion, which is an increase of about 17.55% compounded annually during that time period. To calculate the discount rate, which I'm using to discount their future cash flows back to their present value for this DCF model, I used their weighted average cost of capital, which I calculated using this calculation right here. And you can pause the video to get a better look at it if you'd like to. Also, on their balance sheet right now, when you subtract their debt from their cash, they have a net cash position of $81 billion, and they currently have a little over 5 billion shares outstanding. That means that right now, Google is definitely trading below their estimated intrinsic value per share of around $341 per share, because they are trading at $155 per share. So this is basically saying that based on these assumptions in the DCF model, that Google is trading way below their actual value, and that you would want to buy the stock at this current share price so that you could realize the return on your investment as Google's stock catches up to their actual value. We can also see that I calculated a 50% margin of safety here, which comes out to $170 per share, which means that Google is actually trading below a 50% margin of safety. So again, that's very impressive. We rarely see that with companies, especially in the tech sector, because of how much growth there is in the tech sector. So right here, we can see this industry analysis comparing Google to Meta and Amazon, two of their main competitors here. We can see that based on profit margins, it looks like Meta is doing the best because they have the highest gross profit and net profit margin at 80% and 28%. Google's profit margins are 56% and 24%. But we can also see that Google is trading at the lowest PE ratio. So even though their company is expected to grow a lot, their price to earnings ratio isn't that high, so you could make the case that they aren't really that overvalued, especially when you're taking that into account along with the estimates from the DCF model. It looks like Google's cash flow could end up being very positive in the future and carrying their stock price upwards. Lastly, we can see that for dividend, none of these companies pay dividends, so we don't really have to worry about comparing them on that regard. But if you were just going to look at which company was doing the best based on this list, you'd probably want to give it to Meta because they do have the best profit margins. Lastly, I wanted to compare Google to other companies we've looked at on this channel. On this intrinsic value table, we can see Google comes in fourth place as they were trading 45% below or at 45% of their estimated intrinsic value per share. You can see the other companies on this list. A lot of them are oil companies, but almost none of them are tech companies with the exception of Google and basically Adobe. And even Adobe was not trading below intrinsic value per share. So again, very impressive for Google. Then we can see growth rate here. Google had free cash flow growth over the last 5 years of 17%. These are the other companies that were doing a lot better, but still Google was able to make it onto the top 10 list, which is also very impressive. They don't pay a dividend, so we don't have to worry about comparing them on the dividend table, but you can see the companies here that we've looked at that paid the highest dividend yields. Then based on profitability, Google had about a 56% gross profit margin, which isn't good enough to get them onto this table, but they did have a 24% net profit margin, which was good enough to get them into the 8th place spot on this table. We can see some of their other competitors like Nvidia and Microsoft and Meta and Apple sitting ahead of them. So obviously Google could do better on the net profit margin front compared to some of their peers here in the tech sector. Next, we can see comparing Google to other companies based on their Q4 year-over-year revenue and earnings growth. For Q4, Google came in 6th place with 13% revenue growth and 5th place with 54% earnings growth. Obviously, there were some companies here that did really well, especially Nvidia, which has obviously been on a tear over the last year. We can also see that in Q3, Google made it onto the table, but unfortunately on Q2, they weren't able to do it. So it'd be interesting to see if Google is able to make it or able to last on the Q1 table, because it could show that compared to other companies in the stock market, Google's revenue and earnings are increasing at a much faster rate, regardless of what industry you're looking at, which would obviously be very good news and a good sign for investors who might be thinking about investing in Google. Lastly, based on stock performance over the last 5 years, Google is only up 155%, no dividends either. So compared to other companies, they're not doing nearly as well. We can see Nvidia was doing the best with a 2,000% return over the last 5 years. So let me know in the comment section down below what you guys think of Google. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.